Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes.
Okay, today Mena and I would like to talk about the 6-year CGT rule. And it's something that is discussed online a bit. I've had a few questions on YouTube about it. It's come up in the Investopoly podcast when we get questions from listeners there. And it's something that's not always either widely known about and certainly not widely understood in terms of how you can use it, when you can use it, and how best to utilize it as well in what circumstances. So just as a general sort of description, the 6-year rule, the 6-year CGT rule, however you want to call it, provides for you to continue to claim the main residence exemption for up to 6 years, even if you're no longer living in that property. Now, Mena's going to go through the eligibility criteria in a second. To give you an idea, this rule was really introduced around helping expats, or people wanting to work overseas, I should say. So, if you're moved overseas as a result of your employer, your employer's asked you to go work overseas for a stint, at least you're not going to be worse off from a CGT perspective if you have an owner-occupied house and you rent that house while you're overseas.
So the key eligibility criteria is that the first one is that the property must be your main residence before renting it out. So what does that mean? It means basically from settlement, you used it as your principal place of residence, or if there's a short lag between because there was a current lease agreement in place when you settled and so forth that you need to see through, that's fine, but it needs to be your main residence once that lease ends. So from settlement, essentially what the HO look for to determine, whether you're actually using it as your main residence, things such as changing your electoral roll, your utility usage, do you have things like internet, light, power connected, your gas usage, your water usage, all those kind of things the HO will ask for when determining whether you actually utilised it as your main residence. Obviously, you can't derive any rental income from that for that period, or if you do from, say, a share sort of room arrangement, then you're only eligible for part main residence exemption. Now, during that period, you can't elect any other property as your main residence for CGT purposes, so you can only elect one property at any given time. So if you satisfy those requirements and you sell it within that 6-year window, then the entire gain is CGT free. Now, but if you hold it longer than the 6 years, then only the portion beyond the 6 years is assessable. So i.e. it's a pro-rata for the period that is after the 6 years.
So let's go through a couple of examples here, just very simple examples to demonstrate that. So let's say I bought a home in 2015. I lived in it between 2015 and 2018, so 3 years. In 2018, I moved out and rented that home out. And then I either moved back home with my parents, which I'd never do, or I went and rented a property. If then in 2024, I sell that property, so remember I moved out in 18 and sell in 24, so 6 years later, it means because I haven't claimed another main residence after 2018, the whole gain that I made will be exempt from CGT, because as I said, I've only rented out for 6 years. However, if I actually sold the property in 2025, it means that I've rented out for 7 years. So I've breached that 6-year limit. That means only 6/7 of the gain is exempt. So I'll pay a little bit of capital gains tax, right? And it's based on a number of days. So you look at the total gain over the period and apportion it by a number of days. So even if you miss the period, so sometimes when we have discussions about this 6-year rule, people think, oh, hang on, my 6 years is coming up, but I can't sell it for another 6 months. It's not that big a deal, right? You might end up paying a little bit of capital gains tax, but you're still going to benefit from that 6-year exemption.
Now, there's a few strategic considerations. So say you are sort of nearing that 6-year sort of period, and you might not be selling it in 7 years, you might be selling it in another further 6 years. You can actually reset the clock. So if your circumstances allow, you can actually move back into your property, treat it as your main residence again. Now, although the ATO don't sort of stipulate the length of time that you need to be in there for to sort of convert to your main residence, we generally advise at least 12 months, and for there to be a genuine intention for you to move back in there and convert it to your main residence. So if you do that, then move out again, you get a further 6 years extension to that CGT rule, or that main residence exemption rule.
Now you need to have a bit of a story here, right? Because if the ATO suspects that the only reason you do something is to obtain a tax benefit, then they could potentially throw Part 4A at you and say, well, we're going to ignore this because you only did it predominantly or solely for a tax benefit. So you need to have a bit of story here. I was talking to a client just the other day, and she has a property in a location that is on the other side of the city to where she works, and it's a little bit inconvenient to live in. So she's going to reoccupy that property to start the main residence exemption, but she probably will make a decision, Mena, probably about 6 or 9 months after occupying the property, that driving across the city every day is a pain in the neck. So she will move out of that property and put a tenant in it and go and rent somewhere else, but still take advantage of the 6-year rule. But it's critical in this situation, we've got an answer as to why did you move out, other than because I just wanted to use the 6-year rule in my advantage.
Second consideration, or strategic consideration, is around valuation. Now, if you're going to be using the partial CGT, now it's important to obtain a valuation at the time that you first started renting out the property, because this will give you an uplift in the cost base of the property as at the time, or give you an uplift in what is the current market value of the property when you convert it to a rental property. Now, what that valuations typically stipulates is what the agent or valuer will determine to be comparable in the market. So they'll need to note on the valuation a couple comparable sales to your property. So, similar attributes in terms of bedrooms, bathrooms, land size, obviously within the immediate sort of radius of the property. And that is generally enough for the ATO to use as a valuation record.
Now, sometimes clients will use bank valuations. So particularly if they're restructuring their loans at the time, they might be inclined to use, a valuation by a bank. The problem with that, certainly today, most of those valuations are desktop valuations, which means they're just based on statistical modelling rather than a physical valuer going out and inspecting the property. So they might not be that reliable. Also, bank valuations tend to be more conservative. That's not really going to help you, if you want to minimise capital gains tax. So you want the valuation to be correct, of course. It needs to reflect market value, but we all know property value should be expressed in a range, because there's a bit of subjectivity with it. Well, you want yours to be at the top end of that range. What I typically advise clients to do is go and speak to a couple of real estate agents. Most are happy to do this. Write a letter to tell you what they think the property is worth, and just put in a couple of comparable sales there. If you get a couple of those letters and they're pretty similar in terms of value, they're not going to be identical, but pretty similar, that should be enough to go off. Alternatively, if you need to pay for a fully fledged valuation, if you're more comfortable doing that, you can do that, but it's probably going to cost you $600 to $1,000.
The next thing to consider is around spousal properties. So keep in mind that only one spouse, you can only allocate one main residence per couple. So even if you own properties separately and have lived in them separately, you can only nominate one as a main residence for any given time. The next consideration is around time limits. Now, if your property or for your main residence isn't being used for income producing purposes, i.e. it's not being rented out, and you're not nominating any other property as your main residence, then there is no time limit on how long you can nominate that property as your main residence.
Okay, let's talk about some mistakes that we've seen. The first one is you've got to think carefully about which property you want to claim as your main residence. Of course, it had to be a former home, but sometimes we have situations where, a client has the option to decide which property. They might have lived in both, or might be spending time in two properties, and that can happen where you've got, something in the city and maybe something, in the coast or in the bush that you might use on weekends and so forth. The things to think about are, you've got to think about, what are the future capital gains tax liabilities? What are how will those properties grow differently? What are the inherent or underlying unrealised gains that are already being triggered? But really the key thing to think about is which property are you likely to sell and likely to sell first? Because the key thing here is it's great to just try and think of tax liabilities in absolute terms, but if you're actually not planning to sell a particular asset for the rest of your life, that's a problem for your estate, not a problem for you. And also you want to delay tax as long as possible, because obviously it's coming out of your pocket and there's an opportunity cost associated with that. So typically there might be many considerations, but typically what we will try to do is identify the property we're most likely to sell, and we'll claim that as our main residence. And hopefully what we hope there is that'll minimise the amount of capital gains tax that we pay, even if it means that the remaining asset that we plan to occupy for the rest of our lives, even if it means that it's got a large unrealised gain that's trapped in that property, it's not that big a deal if we don't plan to sell it. The next thing is tracking dates and valuations and these sorts of things. When you rented properties out, where you lived, all those sorts of things. Keep good records, because again, that's going to help in making sure that you obviously comply with the law and minimise tax as much as possible. And don't forget about land tax, because they're two different regimes, capital gains tax and land tax. Land tax is a state-based tax, of course. It depends on the state in which the property is located, whereas capital gains tax is federal. Again, you need to think about what is going to minimise capital gains tax, but land tax is certain, right? You may never sell the property, you may never pay capital gains tax, but each year you will definitely pay land tax. So it's something that needs to be considered.
The final thing to consider is if you become a non-resident for tax purpose at the time you sell the property. Now, obviously at that point in time, you're no longer eligible for the main residence exemption, even if the property was your home for multiple years before you left Australia. However, if you come back to Australia and sell it as a tax resident during that 6-year period, you're still eligible for the main residence exemption. So make sure you get your timing right.
Okay, that's a bit of an overview of the 6-year rule. The thing with tax rules is we can't ever say in absolute way that this is how it's going to apply in every situation. There's always idiosyncrasies, these sorts of things. It's an important exemption, right? There's not a lot of things that are tax-free in life, and the capital gains tax that we get on our main residence is. So it's something to really protect and make sure you benefit from as much as possible. So hopefully this podcast gives you, a bit of an idea around how it works and where it might be appropriate, but it's no substitute for personal tax advice. So go and speak to your holistic accountant about that. Okay, that's it for us for this week. Until next week, bye for now.